Okay, let's get right into it. Welcome everyone to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. If you're someone who loves digging into the nitty-gritty details of financial reporting, well, you are absolutely in the right place. Today, we've got a fantastic real-world case study lined up, and we're zeroing in on the statement of changes in equity. You know, it's an area where we constantly see these subtle but super important presentation errors. So we're going to put our forensic accounting hats on, diagnose a specific presentation issue, and look at exactly what the standards actually demand. But real quick, before we dive into the fun stuff, let's just lay down some quick ground rules. For our reporting period today, we're talking about the standard Indian financial year, so beginning on the 1st of April and wrapping up on the 31st of March. Also, any currency figures we mention are strictly in the Indian rupee. And just a standard but important disclaimer. The views I'm sharing in this explainer are entirely personal and they aren't legally binding. We always recommend that you seek out a qualified expert before you take any action or decide not to take action based on what we chat about here. All right, here's our game plan for today. We'll start with our welcome to the clinic, jump into the reporting observation, look at the Ind AS requirement, move on to spotting the missing element, discuss the impact for audit teams, and finally wrap up with how to join the GAP community. Moving right along, let's hit Section 2, the reporting observation. Now, what's really cool about this explainer is exactly where we got our data. The observation we're breaking down today comes straight from the published Ind AS financial statements of an actual listed company. Gap Advisors downloaded and independently reviewed these statements on a suo motu basis. Basically, that means we proactively went out, pulled the public data, and ran it through our diagnostic process just to see how well the standards are actually being applied out there in the real world. And here's exactly what we found. Take a look at this snapshot of the other equity section within the statement of changes in equity that this company actually published. You've got your columns for capital reserve, securities premium reserve, retained earnings, and equity instruments through other comprehensive income. Now, I want you to look really closely at the rows down the left side. We start with the opening balance as of April 1, 2018. Right below that, there's a row for other comprehensive income net of tax, and right beneath that, a row for profit for the year. After that, it jumps straight to the closing balance for March 31, 2019, and the cycle just repeats for the next year. So I'm going to ask you to pause for just a second here. Really look at that structure. If you put yourself in the shoes of an auditor or a financial controller, based on everything you know about presentation standards, is there anything glaringly absent from that table? Can you spot the missing compliance item? Keep your guess in your head, because we're going to reveal the answer in just a minute. Which brings us to Section 3, the Ind AS requirement. So, the absolutely crucial point we need to anchor on is right here in paragraph 106 of Ind AS 1, which governs the presentation of financial statements. The standard is extremely clear. It says, an entity shall present a statement of changes in equity as required by paragraph 10. But then it goes on, and I really want to highlight this first point. It says the statement includes a total comprehensive income for the period. Notice that. It doesn't say you can just list profit and other comprehensive income on separate lines and call it a day. No, it explicitly mandates the presentation of the total comprehensive income. And just to drive this home, here is exactly how that rule is visualized in the prescribed format required by Division 3 of Schedule 3 to the Companies Act 2013. If you scan down the far left column under the current reporting period, go past the opening balances, past the prior period errors, look at the very bottom row that's visible there. What does it say? It specifically requires a dedicated row for total comprehensive income for the current year. All right, Section 4, spotting the missing element. Let's piece this puzzle together. When we take what the company reported and compare it side by side with what Ind AS 1 requires, the gap is just impossible to miss. On one side, the company listed their other comprehensive income and their profit for the year on two completely separate lines, and then they just stopped. They never aggregated them. But on the flip side, Ind AS 1 and Division 2 of Schedule 3 demand a single, unambiguous line item that gives you the sum of those parts. So our final diagnosis is clear. The company missed it. They completely failed to present the specific line item, total comprehensive income for the year, in the other equity section of their statement of changes in equity. By leaving out that single line, they're suddenly out of compliance with both paragraph 106 of Ind AS 1 and Division 2 of Schedule 3. I know it might seem like just a tiny formatting choice, but in the world of statutory compliance, precision is literally everything. Moving to Section 5, impact for audit teams. This kind of detail is exactly why Gap Advisors exist. The issue we just broke down is just one tiny piece of a massive repository hosted over at gapadvisors.com. We have more than 4,500 specific issues, along with their highly detailed standard-backed responses, covering Indian accounting standards and Indian GAAP. And the best part? Anybody can go to gapadvisors.com and register for free. You can submit your own issues on Ind AS and Indian GAAP, and you'll get a detailed response sent directly to your registered email inbox. This is a game changer, especially for auditors who need to rigorously document exactly how they addressed specific Ind AS application issues during an engagement. I also have to mention that the core of our explainer today was actually featured in the 232nd edition of the Gap Advisors Task Weekly newsletter. This is an absolutely stellar resource authored by CI Manish C. Ayer, director of Gap Advisors, and it's published right on LinkedIn. Think about that. 232 editions of pure technical gold published so far. If you are on LinkedIn, do yourself a favor. Search for it and subscribe to the newsletter for free. It is definitely one of the easiest ways to keep your technical edge sharp week after week. And finally, Section 6, join the Gap community. Look, you definitely don't want to end up as the subject of one of our suo moto reviews for missing a line item. So get your financial statements rigorously reviewed by Gap Advisors before you put your signature on them. The process is incredibly simple. Just save your draft financial statements as a near-to-publishing PDF format. Then, shoot that PDF in an email over to info@gapadvisors.com. Let our experts catch those missing elements before they ever become public record. I want to take a moment to sincerely thank you all for hanging out with us today and for your commitment to accurate financial reporting. If you got something out of this explainer, please hit that like button, drop a comment down below with your thoughts, and subscribe to the Gap Advisors Ind AS Clinic YouTube channel if you haven't already. And please, share this explainer with your contacts, your colleagues, and your audit and finance teams so we can spread this knowledge of Indian accounting standards as far as possible. Also, if you want to keep learning on your commute, be sure to check out the Gap Advisors Ind AS Clinic podcast on Spotify, Amazon, or right here on YouTube for an even deeper audio dive into these issues. So, I'm going to leave you with this final question to take back to your desk. Look at your latest draft. Are your financial statements truly 100% compliant with every single line item required by Division 2 of Schedule 3? Don't just assume. Check it. And if you aren't sure, well, you know exactly who to email. Thanks again, and we'll see you in the next explainer.